Hi everyone, Joe Gentili from Left Tail Risk Advisors. In this video, we're going to start going into some of the types of permanent life insurance that exists out there. And permanent life insurance, really most of them or all of them, they're used when the need for a death benefit is permanent, where there's not a temporary need. You're not simply looking to protect your income, but you're looking to have a certain amount of liquidity at death for a variety of reasons. And that could range from you want to make sure that you leave a legacy to you want a pool of money to help offset estate taxes. You want to um, equalize an inheritance amongst different heirs if there's illiquid assets, or you want to have succession planning, fund to buy sell agreement. There's really a lot of different reasons why people want to have permanent life insurance coverage. And so the most basic form of permanent life insurance, the original form, is whole life insurance. And as the name implies, whole life insurance is to cover you for your entire life. Whole life insurance has a number of guarantees that are built into the product that make it the most conservative way to ensure a guarantee, a death benefit when you pass. And so the guarantees are that the primary guarantee is that there's a guaranteed level premium. And as long as you pay this premium, the policy is guaranteed to stay in force. So this may not sound like something that's a big deal, but when we get to the other forms of permanent life insurance, universal life, variable life, guaranteed level premium is a big deal, and it's something that adds a lot of stability to the plan to make sure that the policy is still in force when you pass. And so the level premium, let's just say, for instance, you have and these numbers are not reflective of actual pricing, but let's say you have $1 million death benefit, and the premium, the level premium for that is $10,000. So it's the whole life insurance starts out looking very expensive versus other forms of life insurance because of that level nature. So let's say you buy the policy when you're 40 years old, you can get $1 million worth of coverage for a 40-year-old for a lot less than, say, $10,000. For a term life insurance policy, that number is going to be in the hundreds of dollars, and for universal life insurance, it'll be in the thousands, but it'll be much lower than say 10,000 if that's where whole life is. But the reason for that is because while it looks really expensive early on relative to these other types of insurance, what you're doing is that you're overpaying early on and accumulating interest on that overpayment early on. This way, later on, you're actually underpaying. It's a really good, you overpay early, so you underpay later. So while it may cost way less than $10,000 to insure a 40-year-old with a whole life with any other type of insurance besides whole life, at 85, 80, when you get into the ages of actual mortality, um, whole life insurance is much less expensive in terms of premium at those ages um, than the other types. The other types can be multiples, many multiples of what it costs with whole life. So whole life is something that when looks very expensive when people buy it, but if they use it as intended and they hold on to it for life, it's something that they're usually happy that they have because it's a very stable and cost-effective way over a long period of time to have a death benefit. So the mechanisms of how this works is, like I said, you overpay the level premium early on. So the $10,000 goes into the policy. Um, the costs and expenses are deducted from that. The remainder goes into cash value. That cash value is then invested by the insurer. So you invest in the insurer's general account, essentially, with your cash value. And they generally invest that money in low risk, high quality fixed income type investments. So that return is then shared with the policyholders in the form of a dividend. If you're buying your life insurance from a mutual company, it's a participating whole life insurance policy. And so over time, that cash value grows. That cash value really serves two purposes. So number one, it could serve as a um, let's say a savings account, a good savings account over time where the cash value increases, and then you have access to that cash value either through taking policy surrenders or through tax-free policy loans, which is for most people is going to be the preferred way to access the money if they need it. So you have this pool of money there that's accessible if you need it. The other kind of more fundamental use of the cash value is that stabilizes the death benefit. It's really its main purpose in the whole life insurance chassis is that as the cost of insurance is kind of deducted later on in the policy, if you have enough cash value built up, that serves as a buffer to keep the policy in force, hopefully indefinitely. Because at some point, if you pay enough premium into the policy, hopefully the returns, the dividends that the policy is throwing off is going to be enough to um, pay for the cost of insurance and keep that death benefit in force without you having to put more premium into it. And that's really what that, along with the guarantee of the level premium, is what makes this a very conservative way to fund a death benefit. Um, so whole life insurance, again, very conservative, straightforward, easy way, and easy to maintain policy because you'll see this more if you get into the universal life insurance type policies, but whole life insurance is just very simple to maintain. It doesn't require a whole lot of sophisticated analysis to keep the policy in force. As long as you pay the premium, the policy stays in force, period, end of story. It can get more complicated if loans are involved. You still need somebody to look over the policy to see if it makes sense for its original purpose. If you're accumulating death benefit or cash value as you were projecting or intending, and whether there's adjustments that need to be made to get that more in line with your needs later on. So it does need to be monitored, but not in the same way a universal life insurance policy does. This is much more simple, which is really important because one of the most overlooked issues with life insurance is that, um, especially for people who are not in the like ultra high net worth category, where they're having somebody or a team look over the policy every year or even more frequently than that to make sure that it's staying on course. If you're not going to have that team in place a decade, 2 decades, 3 decades from now, it's nice to have something very simple to administer where if you just pay the premium, the policy stays in force. So I'm a big fan of whole life insurance for a lot of permanent policy uses because of that ease of keeping it in force. It's a little more dummy proof than some other types. Most whole life insurance today are sold by mutual companies, the big four mutual companies that are out there, and they're all really excellent, highly rated companies, is Northwestern Mutual, New York Life, Mass Mutual, and Guardian. Those are the largest sellers of whole life insurance policies, and frankly, I think they are the most reliable ones to buy policies from. So I'm a fan of the mutuals. I have a lot of experience litigating class action cases in the life insurance industry. There's a lot more issues that come up with policyholders getting a bad deal on the universal life side of the industry rather than on the mutual life insurer whole life side of the industry. Um, the other thing I like about the mutuals is that they're they're more aligned with the best interest of the policyholders. And the reason is because they're owned by the policyholders. So most universal life insurance is sold and distributed by what's called stock companies. A lot of them are publicly traded, where shareholders are out there trying to, maximize their shareholder returns, and they're dealing with policyholders. And so the first loyalty of the company is to maximize shareholder returns, not to necessarily make sure that the policyholders are treated fairly. And that's not to say that all stock companies are bad, but the incentive structure is different than with a mutual company. With a mutual company, the policyholders own the company. There are no shareholders. It's just the policyholders. So to the extent that the mutual company is profitable, those profits make their way back to the policyholders via the dividend. So there's a lot of alignment, I feel, between the policy owners and the company. So that's another point in favor of whole life insurance. So, that said, lots of pluses with whole life insurance. It's got the guarantees. It's issued by companies that are usually have their interest aligned with the policyholders. The rates of return on cash value can be attractive over a long period of time when you factor in the favorable tax treatment of life insurance. So cash value usually, over the long haul, not early on in a contract, but over a long period of time, it's going to look very similar to what other low risk conservative fixed income type returns are going to return, but with better tax treatment. So it's an asset that can play a nice role in people's financial lives, even outside of the death benefit. That said, it's not for everybody. So I wouldn't recommend it for everybody. For people that don't really need a permanent death benefit, I don't know if there's really a great reason for them to have whole life in a lot of instances, or they don't want a permanent death benefit for some reason. If their income is relatively low, I would not recommend necessarily putting a lot of their savings into a life insurance policy, because a lot of the benefit of life insurance comes through the tax treatment. And if you're in a lower tax bracket, then a lot of those benefits may not be as valuable to you. There are some people that um, they have a different risk tolerance. They're okay putting their money into a riskier form of life insurance on the universal life side, and they're willing to take on the risk that the premium that they paid is not enough to keep the policy in force, and that they'll have to kick in more money later. If they're okay taking that risk, then maybe universal life insurance, something on that side, makes more sense. So there's these policies are all tools, and all of these tools have an appropriate use and an inappropriate use. So whole life insurance, excellent tool for a lot of purpose, but not for every purpose. If you have any questions about whole life insurance or other types of life insurance, please feel free to reach out. And as always, I encourage you to subscribe for more videos on this topic. Thanks.